You've probably wondered about this, right? Is your house actually making you richer? I mean, it's a huge question. And believe me, the answer is not as straightforward as you'd think. So today, we're going to break down two of the most important words in your entire financial life, assets and liabilities. And we'll give you a super practical way to finally get a clear picture of your own finances.
Okay, yeah, let's dive right into the deep end with the biggest point of confusion for, well, almost everyone, your home. I mean, you own it, it has value, so it has to be an asset, right? Well, that's where things get a little tricky, and it's exactly why so many of us get tripped up by these terms.
Right, and you've probably seen this super simple definition before. An asset puts money in your pocket, and a liability takes money out. It sounds so neat and tidy, but let's be real. When you try to apply that to your actual life, it usually just creates way more questions than it answers.
Exactly. I mean, think about it. Your house, it absolutely takes money out of your pocket every single month, right? There's the mortgage, the taxes, the repairs, but you can also sell it, and hopefully for a lot more than you paid. So, which one is it? And that's where this whole simple definition just kind of falls apart.
Okay, so here's the big secret behind all this confusion. It all comes down to one simple fact. These words, asset and liability, they weren't made for you and me. They're accounting terms made for businesses. So the trick isn't to argue with the definitions, it's to learn how to translate them into a language that makes sense for our personal lives.
And the best way to do that is to borrow a really powerful tool from that same business world, something called a balance sheet. Now, don't let the name scare you. All it is a snapshot, a picture of your financial life at one specific moment in time. It just answers two very simple questions: what do I own and what I owe?
And really, when you get right down to it, this whole game, it all boils down to this one simple piece of math. You take everything you own, your assets, and subtract everything you owe, your liabilities. What's left over? That's your net worth. That number, right there, is the real scoreboard of your financial life.
All right, so with that in mind, let's go back and finally settle this debate about the house and the car once and for all. And here's the thing, we're not going to pick one definition over the other. No, instead, we're going to give you a much more powerful way to look at it.
And here's the solution. You have to look at everything you own through two different lenses at the same time. First, you've got the on-paper view, or what we call the balance sheet view. This is about what something is worth if you sold it today. But then, you've got the in-real-life view, your cash flow. How does it affect your bank account month to month? Both of these views are crucial, and both are true.
So when we use this two-lens framework, that whole debate about the house, it just becomes crystal clear. From that balance sheet view, yes, it is absolutely an asset. It has resale value. But from the cash flow view, it acts like a cost, a liability, because it's constantly taking money out of your pocket. See? Both things are true.
And you know what? The exact same logic applies to your car. On paper, it's an asset because, hey, you can sell it. But it's a special kind of asset, one we call a depreciating asset. That's a fancy way of saying that while it's costing you money every month in gas and insurance, its actual resale value is almost always going down, not up.
Okay, so what about an asset that's actually designed to make you money? Well, think about buying a stock. Here's a great way to picture it. It's like buying one single brick in a giant, profitable office building. You don't own the whole building, but you own a tiny piece of it, and you have a claim on its future profits. You are literally a part owner.
All right, enough with the theory. Let's make this super practical. What we're about to show you isn't just an idea. It's a real tool you can build for yourself, probably in less than an hour, that will give you that crystal clear snapshot of exactly where you stand financially today. And it really is just 3 simple steps. First, you're going to list your assets. That's everything you own that has real resale value. And be honest here, maybe even a little conservative. Step 2, list your liabilities, everything you owe. For this part, be exact, down to the penny. And then, step 3, you just do the math. Assets minus liabilities. That is it.
Okay, let's look at a case study. We call this one, Looks Rich, Feels Broke. You might even know someone like this. They've got the $300,000 house, the nice car. On the outside, it looks like they've made it. But then you peek at the other side of the balance sheet. The mortgage, the car loan, the credit cards. They're so high that their actual net worth is only $21,000. And you can bet their monthly cash flow is incredibly tight.
Now, let's compare that to case study 2. Doesn't look rich, is building wealth. This person doesn't own a house, no fancy car. In fact, their total assets are way lower. But look at their liabilities. They're so well managed that their net worth is actually higher. And, more importantly, with investments that are growing and zero high-interest debt, their overall financial health is way stronger. Their future is just so much brighter.
So you can see, right? Understanding this whole balance sheet idea isn't just some boring accounting exercise. No, it's the actual key. It's what unlocks smarter decisions and helps you build a genuinely strong financial future. And it doesn't matter what your income is.
So here's the most important takeaway of all. The goal is to make choices that improve both your net worth and your cash flow. You want to increase that scoreboard number over time, for sure, but you also have to manage your monthly cash flow, because that's what determines whether your life feels calm and in control or constantly stressed out.
Now, this naturally leads us to a really important knowledge gap for you to think about. How does inflation mess with this whole picture? As the value of a dollar changes over, say, 10 years, what does that do to the value of your cash in the bank versus something like your house? That's a huge piece of the puzzle for any long-term planning.
And here's another big one. We've been talking about debt as a liability, something you owe. But wait a minute. If a mortgage helps you buy that house, that big asset, then isn't some debt good? This leads to our next knowledge gap for you. What really is the difference between good debt and bad debt? And how do they each affect your net worth?
So, to wrap all this up, I want to leave you with one final thought to guide you. Think of it this way. Your net worth, that's your long-term destination. It tells you where you're ultimately headed. But your cash flow, that's the journey itself, and it tells you whether that journey feels easy and exciting or stressful and difficult. The whole trick is learning to manage both.